We like to understand how the company generates revenue. So we're going to look very closely at the company's revenues, what gives rise to them, the consistency of them. For example, one tech company may have a very good subscription model, and it shows in their revenues because their revenues are very consistent and probably growing over time. Whereas a tech company without a subscription model may have more erratic revenues, therefore their profitability might be more erratic. That's what we're looking so closely at. We're also looking at if there is a subscription model, then that will potentially lower the discount rate of the company for the income approach that we use. So when you lower a company's discount rate, it increases the valuation of the company. So that's one way. And the second way is that if you have a subscription model, it will show in your company's revenues. You're going to have more consistent revenues. Therefore, the profitability of your company is likely more consistent as well. So one of the things we look at for a steady state company, a company that's in steady state, meaning that they have revenue, they're generating profitability, they're likely growing over time, but they are profitable. For those going concern companies, we are looking at the size of the company first and foremost. So if the company generates more than $1 million in revenue, so it's a smaller business, but more than $1 million in revenue, we're likely going to start including an EBITDA multiple. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. That's a very common multiple. We look at that very closely. And the reason why EBITDA is a common metric for us and for most companies is because you can get data from other companies, other comparable transactions that's taken place, and you can calculate the multiple. A lot of times, if you're looking for a different type of multiple other than a financial one that may be based on really less prevalent information that's out there. So EBITDA is a great metric. For a smaller company that is profitable, less than $1 million in revenue, we might use a seller discretionary earnings multiple, or we could use a revenue multiple, particularly if the company's not profitable yet. Now, if the company's in a startup phase, and let's say this particular company wants to raise capital, we're going to look at the company entirely different. If you're looking to raise capital, you're really looking at probably exponential growth. And so with exponential growth and raising a lot of money, spending a lot of money, we're going to look at a very different set of comparable transactions. We're going to look at other similar companies that's gone through rounds of financing. So from seed financing to series A, B, C, and D, and so on. And we're going to look at where your company's at versus where those companies were at in a given time. And then we're going to calculate a multiple that makes sense for that particular stage of growth that you're in. And that's particularly for capital raises.